Welcome to our second panel, which is on the role of collateral in financial plumbing. With a great pleasure, I will introduce our excellent panelists. I will start with Dr. Daniela Gabor. She is Associate Professor in Economics at the University of the West of England in Bristol. Daniela concentrates on the corporate governance of global banks, central banking, especially in crisis, repos, and shadow banking. And recently, together with other distinct academics, she published a book on central banking at the crossroads. Then maybe I'll start with supervisor. We have Werner Bijkerk, head of research department at IOSCO. Werner is a driving force behind the IOSCO activities addressing financial stability and systemic risks. Werner is, of course, leading expert in the implementation and design of regulatory strategies which will to improve investor protection and market efficiency. And among other tasks, Werner is a representative of the IOSCO to the FSB assessment group on vulnerabilities. Then we have Andrew Hill, director at the International Capital Market Association. Andrew is advising on market practice and regulatory policy related to repo and short-term markets. And he has spent more than 17 years trading repo and short-term interest rate markets in a number of banks, including 10 years being executive director at Goldman Sachs. And last but not least, Kevin McNulty. We are especially thankful to Kevin because he accepted our invitation at a very short notice. Kevin is chief executive of the International Securities Lending Association, which he joined in 2009. He also has worked in the securities lending industry for many years, both in the UK and the US. And prior to joining ISLA in August 2009, he worked for Barclays Global Investors, where he ran the securities lending operations in Europe and North America. Let me start briefly, maybe with one sentence I think we can all agree on. I think that collateral has fueled most of the financial transactions over the last 15 years, and yet the last crisis evidenced a number of concerns linked to collateralized funding and securities financing transactions, including excess elasticity in our financial system, weak funding structures, asset fire sales, and negative externalities connected with that for the parties not involved in securities financing transactions, and lastly, additional procyclicality. A revival of securitization by creating more high-quality liquid assets that can be used as collateral is likely to strengthen the central role of collateral in our system, and it might also promote further development of securities financing before basically the related concerns are comprehensively addressed. Where the financial system is a system of promises, and now the trust is built on collateral. But making collateral a new norm might be unhealthy and lead to more interconnected and procyclical financial system. It might also further disincentivize unsecured lending, and we risk that banks will concentrate more on securities than on loans, and basically the risk assessment and taking on risk is the basic activity of banks. It should be. So my opening question after this long introduction would be, should we reaffirm the central role of collateral in our financial system? And I would kindly ask you all to include yes or no in your statement. Kevin, would you like to start?
I'll start. I'll get that over with first of all. Yes, I think is the answer from me. Perhaps just before I'll elaborate on that, I would like to say thank you to the organisers of today. I think it's been a very interesting day, and it's a good opportunity to get involved in a debate about this subject. So thank you for inviting me. The other thing I would say is that back to the earlier comments from our Secretary General today about the. I think he said that an expert is somebody who knows a lot about one thing and very little or nothing about anything else. I consider myself to be an expert on the securities lending market, but rather than knowing nothing about anything else, I consider myself to be a citizen about everything else. And that is that I do care about growth and job creation in Europe. And when I think about the securities lending markets and what happens there, and I'll elaborate on these things later, and the sort of my general desire to see Europe be a place where growth and job creation is something that happens, I see no conflict. So I'll now answer your question, Paulina. So why, do you want me to elaborate now, or do you want to go down the panel and get their yeses or no's? Okay, fine. Why is collateral important? Well, I think first thing I'd say is that collateral is not a novel or new concept. And I know we're some of the paper alludes to the fact that a lot of what we're dealing with concerns financial innovation in the last 10 or so years. But collateral itself is not new. And it's not new to any of us, because we're very used to purchasing our houses and putting our houses up as collateral against loans. The same thing is true of business loans as well. But why is it important to financial markets? And my view is that it's important to financial markets because of system stability. And I think it does create stability in a system, which otherwise would not be there. And I think it's sometimes tempting to think of markets that are perhaps smaller or simpler in terms of what they do. But I don't believe that smaller and simpler markets will deliver the sort of connection between the people that have investment capital and those that need investment capital. I think that, I don't think it's going to work. And so I think that we do need a system of intermediation for some of what goes on in financial markets to make those things happen. And I think whilst we have financial intermediation, we need to have a safe system that's built upon, to some extent, collateral. I also think that, as alluded to in the first panel today, that there's not one single answer here. And I do think that diversification in terms of how financial markets develop is also important. And I don't think one model should necessarily be promoted at the expense of another. I know that's part of what we're talking about. But what I would say is that the alternative to collateralized and secured financing is unsecured financing. And that itself has issues and risks that need to be managed. So it's not that you're just, if you replace the collateralized markets with unsecured markets, you lose all the risks. You replace the risks with a different set of risks. So having said all of that, I'll finish by just saying that I do agree completely that when you get into the world of collateralized markets, there are some risks and issues that need to be managed. And we'll probably touch on this a little bit later, but I do think that the regulation that we're starting to see happen is going a long way to resolving some of the concerns that I think are properly aired in this debate. So we'll come back to that later. Yeah. Thank you.
Again, thank you for the opportunity to come here and be a part of today's event. I think it might be actually helpful to start by presenting my credentials. So underlying my work is very much a belief that efficient, effective, liquid, well-regulated capital markets are actually a public good, and a public good that supports economic growth, development, and jobs. Now, I appreciate that not everybody here believes in capital markets, and maybe some people don't even believe in economic growth. But I don't want to get into an existential debate, but at least you know where my answers are coming from. So with that in mind, do we need to reform the way we use collateral in the markets today? I don't think we really need to radically reform it, but I think, as Kevin touched on, we need to talk about it, and I think we need to understand it. Why do we use collateral in the first place? And is it really this great sea change in the way financial markets work? We use it because after the crisis, there was a loss of trust. The unsecured market closed. There was no unsecured market. Hence, we had the LIBOR rigging. LIBOR didn't exist. You had a multi-trillion-dollar market being based on something that didn't trade. Collateralization allows things to trade. It allows for secured funding. It gives people access to credit they wouldn't otherwise get. It also serves other purposes. I mean, it secures derivatives trades, for instance. It gives that little bit of extra security. It's also, through the repo market, how the central banks operate the liquidity in the banking system and transmit monetary policy. So collateral does actually provide robustness, it does provide safety, and it does provide liquidity. and does help provide better capital markets. But I think we really need to understand the nature of collateral, and I'm sure we're going to touch on this, but things around the reuse of collateral, and is it even reused or is it just used? But I'm sure that will be another question. But I just wanted to pick up on a couple of points about the idea of collateral in securities financing markets being part of the debacle of 2008. I don't think that's strictly true. If you actually look at what happened in the financial crisis, as I mentioned, the unsecured lending markets closed. The European repo markets continued to function. In fact, they really filled the gap. So I think we need to bear that in mind. Also the idea that securitization, and I think this came up a little bit this morning, that the idea of securitization is to provide more HQLA, more quality assets to fuel the collateral and repo markets. I think, I mean, you could say it's a chicken and egg debate, but I don't think that's true. I think there's enough HQLA out there. I don't think we need securitization from that respect. And also, and again, I'm sure this will come up, I also challenge the idea of negative externalities and pro-cyclicality. I think the repo market is very cyclical. I don't think it's pro-cyclical, but I'm sure we'll talk about that a little later.
Okay, thank you. I also want to extend my thanks to Finance Watch for the invitation. And I want to use my prerogative as an academic economist to answer with an it depends to your question. First, I would like to say that whether we like it or not, the financial markets of the future will revolve around collateral, in the sense that the regulatory changes that we have seen, for example, in derivatives trading or in other areas, are asking financial institutions to hold more collateral. We also see structural changes in finance, which Andy Halden called we are entering an age of asset managers, and these structural changes means that market-based finance and collateral markets will become more important and systemic. However, I would like to reflect a bit on this common sense idea that collateral makes a financial system safer, and argue that to some extent historical experience shows us that common sense might be failing us here. And I'm sure we will disagree on that. But let's go back a bit so we don't get accused of having a very technical discussion. Let's go back a bit and put the repo market, which is a market where you can borrow collateral against cash or cash against collateral, put it in the context of the global financial crisis. Since 2008, the Financial Stability Board and central banks around the world have identified repo markets as markets fundamental or central to the shadow banking world. Why is that? And incidentally, academics in the US have described the collapse of Lehman Brothers as having triggered a run on the repo market in the US. So while in Europe we did not have this, or arguably we did not have this in the US, we definitely did. Why do we describe the repo market as a market that is central to a shadow banking world? The answer from and I suggest you read the frequently asked questions about repo on the website of the International Capital Markets Association, and I quote, "The repo market is shadow because it falls partially or entirely outside the scope of prudential capital and liquidity regulations, beyond the safety nets provided by deposit insurance and lender of last resort." Right? So I think there is a general agreement in the regulatory world that repo markets are important for the shadow banking world. If you think about the work that academics and practitioners have done on shadow banking, they define shadow banking as money market funding of capital market lending. So in that sense, all capital market lending has to go through wholesale financial markets. The ECB, in its responses to the European Commission's consultation on the shadow banking sector, has argued that before the crisis, we have seen a significant build-up in the leverage of European banks that can be attributed to, and I quote again, largely to markets that are relatively hidden from regulators, and here the ECB specifically referred to the repo market. Okay, so the question you would ask yourselves now is how can such systemic markets grow hidden from regulators? And we would agree that the volumes are important to call it systemic. And I want to draw your attention to the fact that regulators were very well aware of the repo market, not only because the ECB implements monetary policy, or all central banks use the repo market to implement monetary policy, but because since the 1997 Asian crisis and then the 1998 Russian crisis, central banks around the world had become concerned about the role of collateral and repo markets in global financial stability. They convened a group called the Working Group on Collateral to establish the role that collateral practices and repo markets had played in those crises. And what they had discovered, and you can find the literature there, is that in crises, financial institutions that are dependent on collateralized funding might have problems, might have liquidity problems that are not traditionally happening to a traditional banking sector. And they show that in crises, financial institutions or cash lenders tend to tighten collateral standards in the sense that they accept only some assets as collateral. They might increase haircuts, which is the amount of collateral that they want to accept over and above the cash that they lend. And they make margin calls. In other words, they mark to market the value of the collateral on a daily basis. So there was an awareness since the late 1990s that the repo market and the growth of repo markets in global finance might trigger a financial crisis. However, before the collapse of Lehman Brothers, there was the common sense or the agreement with regulators was that there shouldn't be any regulation necessary. The agreement was that we can rely on financial markets and on repo market participants to fine-tune their practices in order to become safer. And the question is now, since the global financial crisis, whether we have reached a system where we can design out the inherent fragilities of those collateral practices. And I would argue that we haven't. So if we can rethink and ask carefully what lessons we can draw from the run on the repo market in the US, then perhaps we can, I could say a yes to your question.
Thank you. Werner?
Well, thank you for the invitation. There is a disadvantage when you come last that everybody has said what you wanted to say. The advantage is that you can criticize what has been said. So I'll try to balance that out, as a regulator needs to balance both control of the markets and growth of the markets. When I prepared for this panel, I went back to the history, a couple of years, to history of collateral in modern financial markets. And I ended up in the mid-17th century, in Amsterdam, where collateral in the Amsterdam market was used in an OTC way, used and caused problems, as collateral has caused over the last couple of years and has caused during the centuries after that Amsterdam Bourse started with it. So we know that. It's leverage, it's interconnectedness. Nothing new there, and we know that it's good for the markets as well, that it frees up funding and it increases a market. So both things we need to take into account. But I kind of disagree with the view that the regulators really know what they're talking about, and I'm one of them. I publicly admit here that I don't know the risk transfer taking place in collateral transaction at a global scale. I don't know what the risks are doing there because they're not disclosed. And I don't know where the risks are pooling. I don't know which are the big players and what kind of use they make of the collateral they receive. Are they reusing it? Are they hypothecating collateral they get? I don't know about collateral upgrade transactions in those broker-dealers spheres. And I talked to them and I asked them the questions, do you know? How much do you kind of upgrade on your book? And some of them start calculating and come back after a couple of months with some figures, gross figures, global figures. Then I get some of an idea, but still it's not the entire system. Still I don't know the dots in the system. I don't know the interrelations. So this is what I need to know as a global regulator, assessing systemic risk, to be sleeping well. And I don't sleep well. So I disagree with you, Daniela, that regulators know it. And I'm very happy, actually, that Kevin is here, because his institution is probably the institution that knows best of these dots. And he's been starting to kind of pull together all the data that's out there in the world into accessible reports that even non-economists and non-financial specialists can read, and starting kind of getting out of that hidden real shadow, if you want, part of this market that kind of worries me when I'm kind of here in Brussels trying to sleep in a hotel. So that's a bit of the story I have with Collateral. I like it because it has always been there. It's good for the markets. It's good for the economy in the end. But I fear the risk transfer there. And I don't fear risks, don't get me wrong. But if I can't see them, who else will see it?
Let me pick up on this shortly. Do you think that the recent initiatives, for example, at the European level, will have the regulation for transparency for securities financing transaction? It's for sure it's the move in the right direction. Is it enough to make you more comfortable?
Well, you know, it's all very good steps, but you know, we still know, and that's the lesson of the last crisis, one of the main lessons, that it's not a regional problem, right? It started in the US and it kind of flew over to the rest of the world. So if Europe builds a fortress on transparency, and we all know within Europe what's going on, that's good. But then what are the interrelations with Japan, Singapore, Australia, US, Canada? We don't know, right? And that's a big worry. But I'm very happy that we're making baby steps on that road.
Would you like to intervene? Yes?
Yeah, I'd like to add something to that at this stage, because I alluded to in the opening remarks that there are issues related to collateral. We don't hide from the fact that there are sort of different risks that arise in a system that relies on collateral. And I think it is interesting to look back and note what actually happened in the crisis and what actually went wrong. And I'll be honest with you, when I represent the securities lending market, it's a particular part of the SFT world, securities financing market world, where essentially long-term investors like pension funds, institutional investors like mutual funds, sovereign wealth funds, insurance companies lend their securities into the market, and in return for which they get a fee or a revenue from that. And we think that there's a lot of benefits to the financial marketplace and its ability to do its job from that activity. But that's the part of the market that I represent. I can tell you more and more about that if you want, but I'm going to move on. Because the three things that I think we saw happen that I think were problematic in the crisis that were connected to securities financing markets were, the first one was that regulators didn't know what was going on. And that's what the relevance here is. And the FSB has identified that as an issue of high urgency. We would agree with that. We think it is really important that regulators get the information they need to know what's going on. And in the context of the so-called SFTR, the Securities Financing Transaction Regulation in longhand in Europe, we're very, very pleased that the EU is taking the initiative to get something done. We don't see anything really happening in other parts of the world that is similar to this, but it's good that the EU is driving something forward and taking the lead. So we're pleased to see that. As Werner's just alluded to, however, the problem is that if we don't see something similar happen in the US and Asia, the regulators are only going to see part of the story. These are very global activities and global businesses, but you've got to start somewhere, and hopefully the EU sort of move will trigger things, if you like, around the world. The other two areas where I think we saw problems in the crisis, one was, I think, over-reliance on, I'll call it short-term financing by systemically important institutions, and particularly some of the big securities dealers in the US, who are financing themselves very short, and actually they ran into trouble, and that was actually quite a significant issue. And the third issue, which is a very securities lending issue, is we saw some securities lenders lose money as a result of taking cash collateral and investing that cash in the money markets, and some of those cash investments underperforming, so they lost some money. So in terms of, if we were to focus our attention on what went wrong and what do we need to fix, my suggestion would be there with three key areas, because we saw actually things happen. And in all three areas, something is happening. Transparency, we need to get on and do. We need to fix it. In terms of the the over-reliance by systemically important institutions on short-term financing. I think that's being taken care of through the Basel liquidity framework, so I think we're getting there. And then in the third point, the cash collateral thing, which was predominantly an issue felt by US investors, because cash collateral is much more predominant there than it is in Europe. The sort of regulations that we've seen develop around funds, investment funds and regulated funds in Europe, Solvency II for insurance companies, I think is making that much less of a risk, I should say, going forward. So I think there's things happening. We'll talk about some other risks like procyclicality presumably later, but I just wanted to give you my sense as to where I think we saw problems and where I think some initiatives are helping to resolve them.
Thank you very much, Kevin. Andy,
I just wanted to quickly add to that. I think Werner is absolutely right. The regulators didn't and potentially still don't know what's going on in the repo and lending markets. It's with that in mind that ICMA 10 years ago started producing the European Repo Survey, which preempted any initiative that's been launched recently, where we try and take a snapshot twice a year of the European repo market and provide that information, quite granular information. There are 3 ongoing initiatives right now for better transparency. Kevin mentioned one, the SFTR, which is European level regulation. The ECB has its own, just passed a law for money market statistics, which include the repo market and lending markets. And at a global level, the FSB has an initiative. And our members, all the banks, all the participants in the repo markets are fully supportive. That nobody has an issue with transparency. All we ask is that the various initiatives are coordinated, so we're not providing different data to different people in different formats. And also, it would be really helpful if the regulators leading those initiatives had a better idea of what they were actually looking for. And then it would be easier to provide the actual data or position data that they require.
Daniela, you wanted
just to come back to that, maybe I think it's important to clarify that my point was that the regulators anticipated the mechanisms of contagion that the reliance on repo market would create. So if you read the 2002, one of the first papers that the ECB published on financial stability, if you read it, it offers a description of how Lehman Brothers would collapse, right? So this was my point. Well, the very interesting question that for an academic who does political economy is how come that you anticipate the systemic importance of a market, and yet here we are in 2014 and we have industry representatives who recognize that regulators still don't know. This was exactly my point. They don't know. They didn't ask for the information. They didn't want to know. They didn't think transparency was important, although the research that they were doing showed that they were aware of the systemic risk that the market posed. That's all I said. Thank you.
I will pick up on this one. So to wrap it up, we know that there is systemic risk. It's hard to measure. We saw the negative externalities of SFT like asset fire sales. And there have been a few interesting proposals to regulate securities financing markets. We have a proposal on haircuts. We have a proposal on capping the reuse of collateral. We have a proposal of connecting the contributions to DGS, deposit guarantee schemes, in a way with the wholesale funding on the liability side of the bank. Is there a case of implementing a cap on reuse of collateral? Werner, what do you think?
I don't know. I mean, first I would like to see the risk transfers that are involved and the risk pooling. And maybe if you see that as a regulator and you can monitor that at the global level, supervision should be enough. I'm not one of those regulators that is in favor of writing rules just for the sake of showing politicians and the public that you're working on it. I'd rather go to the problem, and sometimes it takes years to get to the problem. And I don't think we have fully addressed the problem yet before we... once I see the risk transfers and I see the dots in that network of the GSIPs, let's start with the GSIPs there, and I see how the transactions are done, maybe it's not that risky. And don't forget, players in the market know what they're doing. They're all professionals like Andy, working 17 years in those transactions. They know little boys and girls. They know what they're doing. I mean, that's my experience with them. But I'm not used to disclose that to a regulator, and a regulator is sometimes not used to go in and say, so what is the biggest risk to the system? Because we don't have a very good global systemic risk regulator at the moment, right? Each regulator regulates on a firm basis, thinks about the country, and that's about it. Mm-hmm. So this is a global thing, and I think we need to do first our homework, gather the information we need to know, and once we have that, analyze whether the risks are big enough to write a rule there and to create a monitoring system. And before that, I don't want to enter to jump to a solution at the moment.
Okay, Daniela?
Okay, I think again it's important to clarify a bit, and I would invite the others to reflect on why I'm not sure that transparency alone can solve the systemic issues that we have seen in the repo market. In the sense that if you look at the research that we have on the systemic vulnerabilities, what we have there is a recognition that there is a very clear relationship between the repo market, leverage, fire sales of assets, and liquidity problems in asset markets. Now, we have a market in Europe and in the US and elsewhere that is a market that is not unregulated. It is governed by the rules designed by private market participants. When private market participants design rules, while they might know what they're doing, still they have an incentive to maximize their own profits, and there is no incentive to think about systemic risk. I invite you to go to any conference of private finance and try to hear for concerns of systemic risk and how we address them. So if that is the case, then it's important to ask, do we need to rethink the way that we regulate collateral market practices? And this is what the Financial Stability Board has done. It has argued if we are moving towards a market-based financial system, then it's not enough to regulate institutions. We have to regulate markets. And the minimum haircuts and the proposals on reuse are proposals that focus on the market itself rather than focusing on institutions. Because what we've learned from the shadow banking crisis is that the moment you try to regulate institutions and to design a regulatory perimeter around institutions, new institutions pop up, they do the same activities, but they don't fall within the regulatory perimeter anymore. So I think it's important that we focus on the initiatives to regulate the repo market, to ask ourselves whether the practices of managing collateral that we know can be destabilizing need to be rethought. And in there, I would suggest not only have minimum haircuts, but think about ceiling haircuts. The example of one systemic CCP, Central Clearing Party, called LCH ClearNet, according to their statistics, they intermediate, they sit between a repo borrower and a repo lender, and they guarantee the flow of cash and collateral, right? So according to their statistics, they clear around 12 trillion repos collateralized with government bonds every month. That's quite a significant amount, I would say. So if you think about the European financial crisis and then the European sovereign debt crisis, one of the main reasons, for example, why Ireland had the financial crisis or was forced to go to the Troika was that LCH ClearNet decided to introduce a sovereign risk framework where they would increase the haircuts on Irish government bonds when the spread between the Irish government bonds and the German government bonds would increase above 450 basis points, right? So we have a system where when the Europe is in crisis, everybody runs to Germany and the spreads go up, and we have a private repo actor that through its collateral practices may make things worse for the issuers of collateral. So I think transparency is not enough. Maybe you agree or disagree, but we have historical examples in the Eurozone, and I can quote you from your website again, where it says greater use of CCPs and aggressive haircutting by CCPs arguably had an effect on the crisis in Greece, Ireland, Italy, Portugal, and Spain in 2011. That's a lot of countries in the periphery. And I would argue that if we're all citizens here, we might be more interested in unpacking these collateral practices and not being, again, reliant on financial market participants to be grown up and behave in a responsible way.
I would agree. I think you highlighted a very important issue with CCPs. I think that is an important debate to have regarding the pro-cyclicality. I think, again, if you're going to argue minimum haircuts, you also need to argue maximum haircuts. So I wouldn't disagree with that. But to go back to the key question about reuse, rehypothecation, I think conceptually it's very important to understand the difference between rehypothecation and what we call reuse, which in itself, I don't want to get into semantics, is a bad name, and also the difference between the European repo markets and the US repo markets. Now, with rehypothecation, and this was a big issue with the Lehman debacle, if I rehypothecate a client's assets, those assets still belong to the client. I am using their assets. So there is a very good argument that the use, rehypothecation, reuse of those collaterals should be monitored and possibly limited, even restricted. No disagreement. The US repo market works on the same principle. The European repo market and securities lending markets are very different. Legally, they're constructed to afford full title transfer. So I take my client's assets, I give them cash. The cash is theirs to do what they want with. The securities are mine to do what I want with. If I default and are unable to return the collateral, they keep the cash. There is no claim on the collateral, they have the cash. In other words, it makes collateral fungible just in the same way money is fungible. So to think of it another way, if there was a proposal that we should start monitoring banknotes, and every time a banknote gets used 3 times, it can't be used again. It can only go back to the person you got it from, or it has to go back to the central bank. Some of the proposals around collateral reuse are just as absurd. So I think conceptually, when we have this debate, it's very important to talk about who owns the assets. And where they're fungible and where title is transferred, then reuse, it's not reuse, it's use, is not an issue.
So tough to go last in this one, but just one thing. As far as I'm aware, there are no concrete proposals anywhere in the world to cap reuse at the moment, but we know that it's on the minds of regulators to look at this. And the FSB announced in November at the G20 summit that they were setting up a task force to look at the general sort of issues that might relate to collateral rehypothecation or reuse, and he's just described what those things are. And I think it's important to look at this and see what the FSB conclude, and they're looking to produce some outputs, I think, towards the end of this year. So we're waiting to see what they come up with. Our sense that the FSB have been pretty thoughtful in how they've looked at the sort of collateral markets and what they consider the right things for regulators to do should be. So I think we should give them time to do their work. I agree with Andy. I think there's some practical issues around sort of simple recapping of reuse, which would be quite difficult to deal with. But I'm also a little bit interested in what the worry is, and I don't know, Werner, whether you could help on this, but there seems to be potentially to be 3 areas that might cause some concern. One is to do with the interconnectivity that reuse creates. So, every time there's an SFT or a use of collateral in the system, it creates a connection in the system. And maybe it's to do with the number of those going up. Linked to that, it might be, and excuse the pun, linked to that, it might be to do with chains and chains of transactions where you get a piece of collateral moving down a chain of different transactions. And the third issue might be something to do with the fact that perhaps people think that there could be more than one claim on the same security. All of those things are, I think, I won't get into the issues now, but I think there are good answers to most of those things. I think the last one is certainly to do with rehypothecation, and I can only see a situation where rehypothecation is done in a way where a client or a customer believes they've got securities that belong to them that are still theirs and are held in an account in their name that happen not to be there, that you might get a situation where there's more than one claim on the same asset. And that's why I think the FSB have already recommended some policy in that area for rehypothecation. But I think it would be important to be clear about what the risk is, what the concern is, and then I think the regulators, I think, job will become easier to, the policy objective will become easier to understand, and I think hopefully the industry can help to find ways to get them comfortable. Personally, I think that rehypothecation is the issue, and it's the area where regulation is needed. I'm not convinced that there are real issues in relation to reuse more broadly, sort of as Andy has suggested.
I guess that some of the regulators, I can allude to their fears. There are academics writing for IMF, and for them, SFTs are basically like money creation, where haircuts are the reserve ratio, and the number the collateral is reused is like the money multiplier. So as long as it's not regulated, we'll have the industry which creates money in the system. And if we are not regulating this, I would say that we have a parallel situation as we had if we didn't, cap a leverage on banks. No cap on leverage of banks, we experienced a happy risk-weighted asset optimization, and we know where we ended. So I think that FSB is a good start, but I think they will cover only 25% of the market. So we have to wait and see what's happening then. I would like to move maybe to real economy, because some say that if those initiatives are successful and we have haircuts, we have some other regulatory measures, it will stop banks, or it will hamper the ability of liquid assets. It will make their funding on the liability side more expensive, and as a result, it will hamper lending to real economy. Is it right, Kevin?
So I think the connection between securities lending and the real economy is probably felt more on the sort of side where the institutional investors are lending securities and generating revenues and returns for pension funds, insurance company policyholders, and the like. And so I think there's a much more direct connection in the securities lending market to the real economy going that way. I tend to believe that that if you make the cost of banks financing themselves a lot higher, then that translates to more expensive costs to the end users of their services. But I think generally speaking, I think the thing that worries me most about the regulation that doesn't just meet the policy objectives but goes beyond that and perhaps sort of starts to harm these markets, I think we'll see the potential for those investors that generate. And in 2013, European fund investors generated about 2 billion euros worth of revenues from lending securities. I think we could see that disappear, and that would just be, in my mind, a bit of a shame. There would be some knock-on consequences for the secondary markets because these securities that find their way into the system are used as in liquidity. They help settlement efficiency, trading strategies, and market making. So there would be some sort of indirect effect. I think the secondary market conditions would deteriorate. But the thing that worries me about the securities lending market is that impact. If you take the securities lending market out, make it too expensive for those investors to participate, they will end up losing revenues that otherwise they needn't.
Andy?
Actually, you didn't mention it in my bio, but I wasn't always a banker, and more recently I actually spent 4 years working in the aid and development sector. And the reason why I mention that is because one thing you learn when trying to structure, say, a poverty reduction program is you identify and target the problem. You don't try and tackle with second-degree symptoms. And I don't have a problem with good regulation, but I just worry that where we're regulating the repo market to indirectly regulate something else, such as, let's be honest, hedge fund leverage, it's not particularly optimal. And we do run the risk of hampering the repo market, which has knock-on effects for secondary market liquidity, which is a cost to investors. So if we're targeting leverage with hedge funds, we should regulate hedge funds. Otherwise, all we're doing is punishing other users of the repo market. So I would argue that good regulation is good regulation, but haircuts on repos just per se is bad regulation because it's trying to deal with the second degree symptom.
Okay, I think it's important to remember that if we look at the institutional structure of the European repo market, this has grown to be, or has started by being the market of large European banks. And this is not me who's saying it's the ECB again. So it's large European banks who wanted to grow aggressively their market-based portfolios, and they use the repo market in order to do so. And even the statistics that come from International Capital Markets Association suggest that around 80% of the repo transactions in Europe are generated by the largest 20 banks. So it's important when we get more information on it to work out to what extent this is, the regulations of the repo market are going to harm traditional banks or banks that are closer to the real economy directly. The second thing that I want to point out is that the question of liquidity is very complicated in a market-based financial system because it's important to remember regulators encouraged in some ways the growth of repo markets because they promised that there would be derived demand for the assets that are used as collateral, and that derived demand would generate liquidity in those markets. However, we have seen since the crisis that liquidity in markets is contingent, complex, and volatile. And it's not very clear to me that in the upswing of an asset bubble, whether the repo market is creating the kind of liquidity that is simply cyclical and will disappear anyways. So we might come to a point where we have to ask ourselves, is it desirable to have very liquid markets? Some people on Twitter, I don't know if you follow, if you're on Twitter, but on Twitter, financial commentators argue and private market participants argue that very liquid markets help even long-term investors liquidate their positions very quickly. So if you make them less liquid, we'll actually create a sort of long-term holding strategies that we want in order for growth in Europe to be restarted.
Thank you. Werner?
Yeah, I've been thinking about the importance of repo for the real economy, and it's quite difficult in these days when central bankers drive the markets to think that repo and interinstitutional kind of collateral-based finance. The level of importance vis-à-vis the central bankers' world. And I was in a meeting, I was in September with the governors of the main central banks at the FSB, and essentially they talked about that point, that we have the financial system flooded with liquidity, and how does it get to where it needs to be in the real economy? And it's a bit linking also to what Martin Wolf said. We are in a liquidity trap, as Keynes would have described it in his general theory. And we now, sitting there with zero interests, we're trying to tweak the plumbing of the financial system and hope that this will change the animal spirits of the entrepreneur. And I don't think that they will change the animal spirits of the entrepreneur. At the moment, plumbing is good, and I think especially when it comes to mitigating potential systemic risk, and taking the benefit of the crisis to do that. But I don't think we all should believe that this will save the world. And if you talk to the main big banks, the chief risk officer or the chief financial officers, and you ask them, so what about your lending? Do you have enough money? Yes, they have. But they don't have demand. So I don't think we will, with this panel, solve the problem. And I don't think securitization as such will solve the problem. We have a bigger and deeper problem here.
For sure. I will have the last question as our time we're running out of time. Do you believe that the repo market can carry the burden of financial integration, and will the ABS, so securitized securities, prove to be the next EU safe asset, as the sovereign bonds failed to do so? Kevin?
Okay, I thought it was interesting that Finance Watch do tie the discussion about asset-backed securities and securities finance together, and actually rather cleverly do so. And I think it's good that these things are mixed together. What I can do is talk about how securities lenders dealt with asset-backed securities in the lead up to the crisis. And I think that gives you some clue as to what they're going to do going forward. ABS, or securitized products, were a very, very tiny portion of what was being lent. And actually, I think that was deliberate. I don't think that the institutions that were lending securities were necessarily comfortable with the idea of lending these and using them to secure other collateral. And similarly, I think there was demand actually from the banks who they typically lend to take securitized products as collateral. And what we saw when we looked at the tri-party collateral managers' books, these are specialist custodian banks who look after collateral on behalf of participants in the repo and securities lending markets. And when you look at the sort of breakdown of the securities that they were taking as collateral for these types of activities, very, very small amounts were in securitized products, very, very tiny. And what I know from talking to our members is that they care very much about what they would call the quality of the collateral that they receive in their securities lending products. These are very risk-averse institutions, by the way, pension funds, insurance companies. They don't want to take a lot of risk in this space. And so will the future asset-backed securities market become something that our market will adopt and use? I think it all depends on their proper assessment of how risky these things are as collateral. And they'll need to pass some tests. They'll need to pass tests in terms of liquidity, their ability to be good collateral. Probably that's probably the main one. So I think it sort of depends on how it evolves. Nobody in our market is demanding the use of ABS. No one's demanding the development of ABS to support anything that they do. If ABS develop as a form of instrument going forward, then there will be a proper assessment as to their place in the securities financing markets.
Thank you. Kevin? Andy.
Yeah, I would kind of echo similar sentiment. I mean, at the beginning, I mentioned the fact that I disagreed with the notion that ABS was being created to fill a collateral need, which is also intonated in the paper. I totally disagree. I don't think it is. And just really repeating what Kevin said, I think a lot of collateral users, collateral takers, are incredibly circumspect about what they will take. And I don't think ABS naturally fills that role. So I think from a repo market perspective, it's very important if you do want a liquid ABS market, that you have a liquid repo market that can support it. Otherwise, you won't have a secondary market. But from a collateral perspective, I would basically dispute the connection.
Okay. Daniela?
Okay, so I would like to go back a bit in time and reflect on the political origins of the European repo market. At around the time of the launch of the euro, was accompanied, so when the euro was launched and the institutional structure around euros were created, was accompanied by what I would call a European repo bargain. And what I mean by that is a political consensus in Europe that the euro area needed a European repo market, which is a market that would integrate the, at the time, fragmented national markets, and it would allow financial institutions to move collateral and cash across the border without any restrictions. That meant sort of homogenizing market practices around collateral management and legal frameworks and all sorts of other things. And it's important to ask why this was a political project that European stakeholders agreed to. And two examples are important. I think for the European Commission it was important because it helped the vision of a single European financial space, which is again the vision that we have in this Capital Markets Union. And for the ECB it was important because for the ECB to fulfill its price stability mandate, we needed a financial markets that would respond in the same way to the price signals of the ECB. So what we had in Europe is not that repo markets were hidden, but regulators were helping create a European repo market. And you can look at the Financial Collateral Directive from 2002. It basically puts into practice the recommendations of the private industry in the Giovannini group and the Giovannini report. What we have had since the crisis is a breakdown of this European repo bargain, in the sense that it's no longer an easy sell in political circles that the European repo market can trigger financial integration. simply because there is a big elephant in the room of the European repo market, and that elephant is government bond markets. Before 2008, the European repo bargain promised member states that private financial institutions would treat any bond issued by governments in the euro area as equivalent collateral. Since then, this is no longer the case. So I think we might want to think about the idea that we need a new European repo bargain, but no longer on the terms designed by private market participants, but on the terms designed by European regulators.
I learned a lot from this expose. I didn't know that history. Very interesting. Maybe the ECB is trying to do that with the QE, trying to push the spreads back to zero and make it de facto interchangeable. But yeah, that I don't know. I don't know an answer on this question.
Okay. I think we might take one or two questions from the audience. So, since there is one and there is one.
Thank you. Guillaume Prache, Managing Director of Better Finance, the European Federation of Financial Services Users. And that was a very interesting panel, thank you. My question is that you focus mostly on systemic risk, not too much on the cost and return to the real economy and the economic and social value, not only of collateralization, but also you talked a lot about securities lending. I think Kevin alluded to the decision from ESMA in 2012, which in fact we pushed, I was chairing the stakeholder group at that time of ESMA, to that 100% of profits of securities lending made by fund managers are returned to the fund, are returned to the end investors, the real investors. Now I have a question for the whole panel, because I am quite struck now that since 2012, if I am an EU citizen, I invest in the capital markets through a fund. If the securities are lent, I get 100% of the profit. First, I know they are lent. Second, I get the profit. When I invest directly into the capital market, when I buy shares, what happens? A lot of shares are put in omnibus accounts and they are lent without my knowing, and of course, without any profit going back to the investor who is bearing the ultimate risk, and he is the owner of the asset. So my question is, what do you think about this, which seems to us quite a very different treatment of investors? Thank you.
Yes.
Thank you for the question. And so first of all, we didn't focus on those issues that were not related to sort of systemic issues, because I think that was more the focus of the session today. But thank you for raising those points. So the question at the end is if you invest in a UCITS fund now, because of the reforms that have taken place fairly recently in Europe, investors get a lot of information about the securities lending practices of the funds, and the return is has to be returned to the fund itself. So they were reforms that we supported, by the way. So the question was, what if I invest in these shares directly? Am I likely to be in a securities lending program that I don't know about? Now, my honest answer to that is I don't think that's the case. I'm not aware of anywhere where an investor who buys shares, who holds them perhaps through a broker or through a bank, should be in a securities lending program without their knowledge. And if that were to happen, we would absolutely consider that to be bad practice. And actually, I think in most cases, would be outside of regulation, certainly outside of the regulation of the UK, for example. I'm not sure of anywhere else in Europe where that would be permitted by regulation. So if you have examples of that happening, then we would be interested to know, but we're not, I'm personally not aware of that happening. Thank you.
Would you like to add something? No. There was one question.
Thank you. Bertrand Huet from Fleischmann Hillard. Watching this feels a bit like watching a bit of the debate on OTC derivatives 7-8 years ago. Clearly different products, although clearly also a lot of synergies in terms of collateralized businesses that we're in. One question, apologies if it's a little technical, but are there any lessons from your side, from where you sit, that you think can be usefully learned from, the experience of EMIR here in terms of how we approach, and clearly the SFTR regulation is adopting a similar, trade repository reporting model, but are there any lessons, particularly in terms of how transparency can potentially also contribute to helping with, analysis of systemic risk? What are your thoughts about some of the lessons that can be usefully learned, or some of the pitfalls to perhaps watch out for as we build up the SFTR regulation in the context of some experience that we've seen on EMIR?
Who should answer your question? All panelists?
Whoever. All of them.
I'll kick off and I'll be brief. I think the lesson learned is in terms of transparency in projects like SFTR and other transparency projects for SFT markets is, one, be realistic in terms of what you're going to get and what you can manage, and two, know what you're looking for. Actually have an understanding of what you're looking for, because if you're just looking for everything, you'll get everything and you'll know nothing.
And just very briefly on that, I would add that, so this SFTR thing, which is going through the legislation process at the moment, follows about a year after EMIR. EMIR was the instrument that produced the requirement for transaction reporting of derivatives, and SFTR does the same job for the securities financing markets. I think the simple observations would be, for me, is let's make sure we learn from lessons in EMIR. We hear lots of stories. It's difficult to know, what's right and what's wrong, but a lot of data is collected. A lot of very, very detailed data is collected on EMIR. It's collected from both sides of the transaction. It's reported to different places, to different trade repositories. And the simple question we have is that the best way to create the sort of informational needs that regulators have? It seems like a complex web. It seems like a lot of information. We've been engaging with policymakers on this and have some proposals. We think, for example, it makes sense to rather than capture individual transactional items, to take a snapshot every day of all the exposures in the system between different parties and for different instruments. And that would be a relatively easy thing to aggregate up for regulators if they need to see very quickly what the exposures are, either by the security type, security, or legal entity that's involved. So I think learning lessons from EMIR, I think, is the lesson, I think.
Just very quickly, for me, the lesson is that we need true transparency in the sense that the information should not only be shared between the market participants and the regulators, because we know regulatory capture exists and it happens quite often, and we need academics to have access to this data in order to be able to provide an input that might sometimes be objective or independent, so we can all think together about the systemic problems.
They'll probably sell it to you. They'll probably sell it to you.
They'll probably sell it to me. Well, there you go. Maybe the European Commission can fund the...
So it all sounds very well. So it should be concentrated in a global securities market regulator, which is IOSCO. I want to say EMIR is nice, but you should have a global EMIR. And I'm not a big fan of casting the net wide like the FSB tends to do and start very broad and then after some years approaching what we call risks. I would like to start with the risks and select 3 of those biggest ones and then collect the data around those risks and start from there, which is the world upside down. And it takes a bit more time to do your analysis based on the lack of data first and talking to the market and start to collect on a case-by-case basis. But I think it's more effective, less costly for the market as well, and also for regulators. Don't forget that regulators are under-resourced and cannot handle the amount of data that are at their tables. I mean, it's incredible what the post-crisis regulation across the globe has kind of produced in terms of data. They're completely stretched, and I'm pretty sure that they won't find the things you would like to know as a regulator. So data is not a panacea. It's information, and start thinking first before you get out and say, well, give me everything on securities finance and then I'll find out.
Thank you very much. Thank you very much for this excellent discussion.